Hello, everyone. Thanks so much for joining Business Valuation Masterclass. Looking forward to getting into the content and sharing some really valuable insights here. We'll just give it 30 seconds or so for people to join because we are just on 12 o'clock, and then we'll get straight into it. So, yeah, just give us 30 seconds or so. I can see there's still people joining, which is great. Welcome. Perfect. So yeah, people will continue to join. But yeah, like I said, guys, thanks so much for joining. I'm Graham Davies, founder and CEO of Edition, and really delighted today to be joined by Graham Stephen, who's one of our partners and a friend of mine over in sunny Cape Town, who is the founder and CEO of bizval, business valuation specialists, and been doing this for many years and valued lots of companies. So there'll be lots to share. The format of this will be, we've got some content we're going to talk through, and then at the end we'll leave some time for Q&A, and I'm sure you've got lots of questions. But throughout the presentation, if you have any questions, please feel free to post them straight into the comments, and if the timing is right and it's a relevant question for that time, then we'll discuss it in real time with the content that's being presented. So yeah, with no further ado, let's crack on and get into it. So really quick intro about me. I'm Graham Davies, like I said, the founder of Edition Finance. My background is in corporate finance and FP&A, and worked on lots of projects that included business valuation as an element of it, as well as financial planning and everything else. Edition Finance is a financial management service and platform for SMEs and high growth businesses, and we support lots of businesses through fundraising and scaling their business. And now hand over to Graham Stephen, who will give a quick intro of him.
Great, thanks, Graham. And yeah, always a pleasure to partner with you. And I always say you're the one Graham whose name is spelled correctly. And no offense to all the Grahams who's spelled with an E, but great to be here today. I think just by way of background quickly, you can all read what's on the screen, but bizval was we created bizval a few years ago, really to cater towards entrepreneurs who are building businesses, either startup, scale up, or even getting ready for exit. And we really felt there was a gap in the market to really empower the business owner and the entrepreneur to make better decisions around understanding and unlocking the value in their business. So that was our mission, and our mission is to reach 10,000 entrepreneurs to help them make better decisions around creating long-term value, as opposed to just going through the motions of monthly payroll and trying to keep the lights on.
Perfect, thanks, Graham. We're going to refer to you as Graham S throughout this, and I'll be Graham D, just so we keep it straightforward. Two Grahams on a webinar sounds like a lot of fun, doesn't it? Yeah, quick agenda, probably 5 to 6 minutes on each one. First of all, we're going to talk about understanding startup valuation, why it's important. Second point will be around building for value from day one. So how do you set up your business for value from day one? How to calculate your company's value. High growth companies versus small, medium-sized businesses and the different kind of characteristics and factors there, which is really important consideration, and value drivers and detractors. So what to do to maximize value and what not to do so you don't minimize your value. And then at the end, some Q&A, as I said. So let's get into it, Graham. Over to you. So first section, understanding startup valuation and why it's important.
Fantastic. Thanks, Graham. So yeah, I think just to precursor this is, there are going to be a few sort of themes and principles that are probably going to be repeated a few times through the presentation. As a mentor once told me, when you're presenting to an audience, imagine it's, and no disrespect to anyone on the call, but, we experts in this content, we deal with it every day. But, he said, imagine you're presenting to a room of grade 8 students and, tell them what you want to tell them again, and then repeat that in the summary. So there will be a bit of repetition, and I think it's to kind of emphasize the key points. The other thing I just kind of want to mention is we use the word sort of startup and high growth company in the presentation, almost interchangeably. And I do want to precursor that, we're not necessarily dealing with, a Google Cloud as a startup, these big, massive infrastructure type startup businesses that require a lot of upfront investment in that. We'll cover some of those in the principles, but we're talking about startups and high growth companies in general. So, please feel free to, if you have any questions, jump in as we go along. But I think to kick off, why are valuations important? The focus today, for startups and high growth companies is often about raising equity, thinking about an exit at some point in time, but also managing growth. There's a bunch of other reasons that you would do a valuation for, if you've got a company share option scheme, investment analysis, all those kind of things. But, for the purpose of today, we're talking to founders, we're talking to owners, maybe some funders. We kind of want to focus on, those top three: raising equity, building to sell, and managing growth. I think, Graham, if you move on to the next slide.
That's right.
Yeah. And, I think the most important thing is often people get hung up about the valuation number itself. For us, it's actually less about the valuation, but it's actually the process of going through the valuation and understanding what the key drivers of value are. And, there's often a saying that, investors back the jockey. And one of the things about the jockey or the owner of the business is, do they really understand the fundamentals of the business? Do they understand how it makes money, how it can make money in the future, what the growth levers in that are in the business? And it's really important, by going through a valuation process, it helps unlock and highlight what some of those growth drivers and the growth levers are. Simply from a valuation perspective, and I know I might be oversimplifying it, but value is generated from the ability to produce future cash profits or future cash flows. Now, for the most part, people talk about financial versus strategic value. There will always be something which is a strategic purchase, where the reason for acquiring puts this multiple or huge value on the business, which isn't necessarily in line with the current fundamentals or potential of that business. So for the most part, we're not talking about strategic value, but we're talking about things that most owners and entrepreneurs can control. And that function of future cash flows is really dependent on your growth assumptions. Okay, so how quickly can the business grow and how can it sustain that growth? And then also the risk and the rewards associated with that growth. Okay, so that implies that it's not just about revenue. If you're going to be producing future cash flows, it's about profit. So really understanding the unit economics and the drivers of that cash flow is absolutely critical. The second thing is that there's not always a right answer when it comes to valuing a company. Yes, there's scientific method, and we'll cover some of that a little bit later. But it's a craft, and I've used this word before. I use the word craft rather than art, because there is some, judgment and expertise that goes into this. But usually there's not a right answer. It's a range of answers, and understanding the sensitivities is really, really important. You need to know, if I pull lever X, what does it do? How quickly does it ramp up value or detract from value? The third point I want to touch on very briefly is, in high growth businesses and startups, often, you'll have VCs or investors talking about a valuation, but sometimes that valuation is a little bit misleading. Sometimes it's around how much equity is needed to reach the next funding milestone. And I'll use an example over here. A lot of incubators, for argument's sake, will value a business at X. But how a lot of these incubators work is they provide, let's call it a 12-week program, and they put a value on what that 12-week program is worth. Let's call it £100,000. And for that, for you to be part of that program, they'll take an 8 to 12% stake in your business. And all they do is they kind of reverse engineer that, and they say, okay, well, the value of our 12-week program is £100,000. So by implication, your business will be worth, 1/12 of that value, and they put £1 million valuation on the business. So, it sounds very simplistic, but in practice, a lot of the time that's what happens. And I think just something we'll touch on a little bit later as well is founders also need to be aware of some of the factors that are beyond the valuation. So sometimes founders are quick to take money at this astronomical valuation. They get seduced by the high number. But there are other terms and conditions often in these funding arrangements, which mean that if you don't hit very aggressive growth targets and you don't hit certain things, that actually that value only unlocks if you hit those. So you might be seduced by a high valuation, but actually when you read the fine print in the funding agreement, there's things like preferred returns, shareholder dilution, and in many instances, founders can find themselves almost losing control of their company and getting nothing out unless they hit those very high growth targets. So Graham, I don't know if you want to jump in here quickly before we move on to the next section, but
just on that,
I just want to touch on some of those fundamentals.
Exactly, and that final point as well. I think if you read TechCrunch, as I'm sure everyone does, and those sorts of kind of articles, you'll see that there's huge valuations out there, particularly in the US. And whilst they have raised that valuation, there are preferred returns, etc., and different preferences that some investors have, which actually means that they have to really grow into that valuation and more in order to actually see a return for the founder. So, I suppose my overarching point there is a value for selling your business is different to a value for raising money. And I think you see that quite a lot. A lot of those businesses that are raising at, 200-300 million or $1 billion valuations, and they're quite small, they wouldn't be able to sell for that value. It's purely a fundraising valuation. And then the other point to add to what you said, Graham, about there's no right answer to valuation. The thing I would add there as well is, if you speak to 2 or 3 different funders or valuers, then they might all come up with different valuations for the company. And that's because they might have different return requirements for their funds, or they might have different assumptions they build into their model for your business around growth, because they can help you more with growth, and therefore they'd be happy to support a higher valuation. And so, unfortunately, although I wish there was a single answer and this is the market value of the company, it's actually really hard to land on that.
100%. I think understanding those sensitivities is absolutely key. We'll talk about that just now. If one investor's got a high risk appetite, another's got a lower risk appetite, their required return would be different, which, when you talk about discount rates, can result in a different outcome. And if you know what type of investor you've got potentially, you can understand how they would negotiate. So let's move on to the crux of this. We're talking about how do you create value. And I think the first thing is around when you're trying to build a business of value, it's important from day one to think about building a business of value. And there's really 5 key principles we want to reinforce. These are going to come through over and over again. The first one is owner dependence, or owner independence rather, right? Is what's really interesting here, particularly in startups. We spoke about the jockey. Initially, an investor is backing the jockey, but they're not backing the jockey to be the person who is going to be doing all the work. They're backing the jockey to kind of execute the vision, create the vision, make sure that you keep momentum in the business. They're not backing an operating officer. So I think this is really, really important, is that this is probably one of the single biggest detractors from value in the long term, is when the business is dependent on the owner. So from day one, you need to be thinking around, how do I build a business, or how do I grow a business that's not dependent on me as an owner? Which kind of leads into the second point. And a lot of businesses, neglect this. They get caught out by growing too quickly because they don't have effective and scalable processes and systems in place. Now, that's not to mean you must go on day one and buy the most expensive, CRM and sales pipeline management tool that you can find. For a lot of businesses, even building something in Excel might work to a point. But you have to have a mindset of saying, every process that I put in place, is it scalable? How does it ramp up? How does it support my business? Not as it is now, but can it support it when it is 10 times the size or 100 times the size? Or can it be adapted and modified to be able to do that as you grow? So that mindset of owner independence and building systems is crucial. The other key point I touched on at the beginning is around strong unit economics. Now, I know a lot of high growth businesses want to grow through like, let's buy a market share, make our product cheap so we can get lots of market share. But it's very, very difficult if you do that to kind of reverse the charge. There are 1 in 100 companies that get that right. They build a massive audience and then they start to monetize it. But for most businesses, having a handle on what your unit economics are, the difference between what you charge and what it costs you to provide that service, is absolutely critical. And I think we've seen this mistake. You know, if you've got a loss-making unit economic situation, you grow fast. All you do is you make the hole deeper. You don't create value. And that then is what creates issues when it comes to things like shareholder rights and, you know, those drags, and you as a founder potentially losing control, is you can actually create a lot of problems for yourself. So an understanding of your unit economics, even if they're not strong to start with, you need to have a roadmap to say, how am I going to generate better unit economics over time? So that, number 3, is a key point. Probably should have mentioned this up front, but a robust understanding of your customer. Okay. There's a bit of an assumption in here. So we're talking about high growth companies. There's almost an assumption already that you've got some degree of product market fit. You're solving a real need, and you've got a product that meets that need. Now, there may be businesses or people listening who haven't yet got that product market fit right. And I would say that if you haven't got it right yet, it's really important not to spend too much money on designing a Rolls Royce when what you might need is a bicycle. So you really need to understand what your end user requirements are and how those could potentially evolve. So I can't emphasize this enough. If you want to build a business of value, really understand what your pain points of your customer are and how you solve for those. And then the last point is, in a high growth company, you need to make sure that the market is sufficiently large to achieve, you know, that sort of desired exit outcome. You know, there are instances where you can build, you know, where it's a very tight niche, but being able to have a market which is big enough is absolutely critical. And when investors look at it, they often talk about total addressable market and all of that sort of stuff. And that's what they're referring to. Is the market big enough? You know, is there enough need here to actually build the business? The last thing that's not on here, and again, I want to just touch on this, is you need to think about your moat from the get-go as well. What I mean by a moat is, we see a lot of business owners who are quite naive when they build out their businesses. They think that, you know, they've got great pricing margin and it's going to stay like that forever. But you've got to be thinking about what happens when competitors come down the line, because they will. If you're successful, you're not going to be the only player in the game. And you need to think about what are those things that make you different, make you unique, and make it hard for people to kind of just come and replicate and do what you do. Case in point, very quickly, is we had a case study. A client had built an online travel booking business, very successful. And effectively what happened is they were making decent money, good growth, and a company in the US basically reverse engineered their product and spent 100 times what they were spending on Google ads and put them out of business because they had absolutely no moat. So, you know, it can happen, and you've got to think about that moat from day one, not down the line. Graham, any other thoughts before we move on?
Yeah, I always think about that in terms of, you know, at the outset, trying to build a product or service which is, you know, 10 times better than the status quo, 10 times better than what's out there today, because that's going to attract customers to you and help you build those natural moats for a period of time until someone catches up with it. Then you kind of need to rethink it all the time. But also that approach, I think the 10x approach, is better than raising loads of money without strong unit economics, throwing money at it and trying to gain market share, and market share being your moat. That's a much higher risk strategy, I suppose, than trying to build that 10x better product. So really interesting points. And I just want to say as well, like, your financial model, if you've got a really functional financial model, can really help you understand the impact of these things on value as well, to make sure that you are, you know, modeling your business in the most valuable way.
And that's critical. And I think what people often misunderstand is that model doesn't need to be thousands of lines on an Excel spreadsheet. It really needs to be understand the key value drivers, the key things, and be able to flex those and scenario plan around that. And that's where having, someone like, a fractional CFO or someone from Graham Davies' team is really powerful. They can help you model that in a pragmatic and understandable manner. I think a lot of the time people think they need to build this like monster spreadsheet that can actually cause more harm than good often.
Absolutely. Yeah. Simple always wins.
Yeah. Okay. So we're going to talk about calculating value now. So Graham, if you can just move to the next slide. And I think I want to touch on this briefly. So there's this misconception. I say, beware the revenue multiple. And, a lot of the time with high growth companies, you'll see, particularly in the US and in Silicon Valley, I talk about the revenue multiple, and everyone gets hung up on this revenue multiple. Now, the challenge with the revenue multiple is it only measures the top line. It doesn't factor in unit economics. Often people will look at something like an Uber or an Airbnb or one of these sort of big platform businesses and say, oh, well, they're trading on a 10 or 15 times revenue multiple. My business must be the same. And I think there's a lot of challenges with that. One is it's not taking into account profits. The revenue multiple also varies. When your economic situation changes, if you're operating in a low interest environment and low inflation and money costs you nothing, compared to a higher interest rate environment, which we find ourselves in now. And you see that's what's happened in the sort of VC world is the money shifted. Those astronomical revenue multiples have cooled off. So revenue multiples are not, sensitive enough to changes in the environment. And they're also not sensitive, I guess, in many instances, they don't really suit sort of smaller businesses. So you're comparing often irrelevant big platform businesses versus even though it's a high growth startup, it's not going to be the next Amazon, most likely. So it's far better to understand your unit economics, your profitability, and exercise caution when you're thinking about revenue multiples. I think we're going to move on to the next slide. When we think about valuation, and we touched on this at the beginning, is, the discounted cash flow really is, and I know people will have different opinions on this, but this is really where it's at. It's about understanding the future value of all cash flows, the growth rate, fundamentally, how quickly can you grow and what risk is attached to that. So that brings in all those elements of owner dependency. It brings in elements of how big is the market, how scalable is this? Can your systems cope as you grow? And the discount rate is what Graham touched on earlier, other Graham, is that what is the expected rate of return that somebody wants to get out of this business? And in many instances with high growth companies, there's high potential growth, but there's also high potential risk. So sort of discount rate that people might want to get out of this might be a 40, 50% a year annual return. VCs want to 10x their money. So if you work backwards from that, it tells you what kind of rate of return and what kind of growth rate you need to sustain to be able to hit those valuations. And then the other part is also around enterprise versus equity value. So when you value a business, you value it as a whole. But if you've taken on debt and you've leveraged that growth, when things are going well, that's great. But if things turn the other way around, if you've got a very highly leveraged business, it can go the other way around. So, the business can be worth a hell of a lot less than the debt that you actually used to fund that business. So discounted cash flow, really important because it talks to the fundamentals of growing your business. We touched on the multiples. I'm not going to spend a lot of time on that now, but revenue multiples is one, earnings multiples is another. And what multiples do, I always talk about, is an output-based methodology. So multiples look at similar businesses and say, what did they trade at? It doesn't look at your business like a discounted cash flow does and say whether that's achievable or not. So you've got to exercise that with caution. And then the analogy I often use is if you took, 5 6'3", 120 kilogram men and put them in a row, it doesn't mean that they all front row rugby players for the England rugby team. Okay. One of them might just be a big guy who's a couch potato. One of them might be a cricketer. One of them might be something else. So that's the danger with multiples, is you have to step back a little bit more and understand what are they actually telling you. And then the net asset value, particularly for high growth companies, it's not really relevant usually, but that's effectively the old sort of accounting basis. What assets do you have? What debt do you have? And what's the difference? And the challenge with that is it doesn't look at future growth. It looks at where the business is now. So if we move on, I think to the next slide.
Graham, actually on this, we actually have quite an interesting question, which I thought we could maybe dissect now, if that's okay with you.
Yeah, sure.
Let me just ping that up now. So Mark is asking, how do you adjust the discount rate for the risk in a startup valuation? Is the first question. And do you make your DCF converge with a multiple valuation? So the first point around discount rate, it's obviously it's a real big topic, isn't it? How do you land on a discount rate for a startup, Graham?
Yeah, so this is, again, this comes down to the type of investor that you're trying to attract. Often, if you're looking at it through an investor's lens, it'll be how much risk appetite does that investor have? So if you're dealing with, let's call it a VC who wants to 10x their investment in 3 years, okay, you can work backwards from that. They might have a discount rate of 40 or 50%. You might have another type of investor who's maybe a more patient investor. They want growth, but not as quickly. So they might, actually have a lower discount rate, sort of, 30 to 40%. What we're seeing in the startup space and high growth space is discount rates anywhere between 30 through to 50, 60%, even at times. So the less proven and the more immature the idea, generally the higher the discount rate. Compare that to sort of your traditional SMB space, where you're talking discount rates in the UK are probably anywhere between 18 to 25%, in some instances, maybe even lower. So, there is a big difference between the two. I think, as I said, the multiple is a reverse engineering almost, so I do think that, it's not as though you try to converge the DCF with the multiple. The multiple is the output of generally. And that's why, we say that multiples be quite dangerous, So if you valued a tech business, let's call it Zoom for argument's sake, at the height of the COVID pandemic, when, Zoom shares were flying through the roof, money was free, user growth was going through the roof, astronomical valuation multiple. But look what's happened 3 or 4 years down the line, where things have normalized a little bit, those valuations have come off tremendously. So you need to be quite careful about that. I do like that last point there, is this using options to value a startup. And I think this is a really, really key point, because if you look at it through the lens of a VC, sometimes what they're doing is they're actually taking a bet. So in a VC's portfolio, they're banking on, 1 in 100 of their portfolio companies hitting it massively. Okay. So effectively that is, through their eyes, they look at it as an option. They're placing bets on the roulette table and thinking that one of those is going to come off. So, it is a bit of a more sophisticated technique, but, when you're looking at it through the lens of the investor, that's a great point. And option valuation techniques are something that we look at from a startup perspective. We, in our approach, call that the sort of blue sky approach. What happens if this comes off really big? And we apply a weighting to that versus, let's call it, the more traditional approach of valuation. And that can change depending on the risk appetite of the investor.
Awesome. Thanks, Graham. Yeah. And also just to emphasize that point as well, although it's, in popular culture, things sort of change, but in my experience, the multiple approach to valuation was almost always an output. So you run your DCF, you agree all of your assumptions, and then to make it really clear and understandable to a layman, a non-financial person, because it's quite difficult to understand a DCF and IRR and all those terms, you actually then present it in a simpler term, which is, that's equivalent of 10 times EBITDA or 15 times revenue.
Correct, yeah.
And so those are then used then as proxies going forward to value companies, but really are an output. And I think those assumptions in the DCF, which come from your financial model, from your business plan, those are the key value drivers that will help you arrive on what a sufficient revenue or EBITDA multiple is for your business.
100%. As you say, there's nothing wrong with using multiples, but provided you understand what the key assumptions are that unlock that. And that's where a lot of people, go wrong or forget to ask the next question.
Indeed.
Great.
quickly
So
on this one, Jeremy, I guess.
yeah, so I'm just keeping half an eye on the time, and I think this slide I'm not going to dwell too much on, but I do think I'd like to highlight a couple of sort of differences between high growth versus, let's call it, traditional SMB companies. And I think we've already spoken about differences in discount rates and all of those sorts of things, but a high growth company, often the reason for the valuation is because they're wanting to grow. They're needing to raise money for future growth, strategic planning, share incentive schemes. So often the reason for having a valuation done is quite different. Where traditional SMBs usually, from our experience, has been around some sort of exit planning, looking to grow via acquisition. So often the reason for doing a valuation might differ between an SMB and a high growth business. But I think this is a key point. We touched on that, is the risks are often very different. An SMB has got a track record. It's a known quantity. So it's easier to refer on past performance and past multiples. And that's what results in a lower discount rate. Whereas a high growth company has got higher risk. There's less track record. You're often shaping a market. You might be a first entry into this market. That reflects in the higher discount rate again. There's more risk associated with that. But equally, if you get it right, the sky could be the limit. So I think that's a big differentiator. The principles that underpin it are exactly the same. How it gets manifested. And then I guess as a business owner, you need to be able to demonstrate flexibility. And this comes into optionality again. When an investor is looking at a founder of a high growth company, they're often backing them to say, well, we're backing them to figure out how they're going to grow. Okay. We're not backing them just to continue doing what they were doing in the past with like an SMB, but we're backing the founder to know that they will figure out a solution to the problem. And that's where the optionality piece comes into it. I think market size and potential, we've spoken about that. I think, again, there's a lot of unknowns there. It's new concepts. It's assumptions based. So one of the things that an investor does when they're talking to, a founder of a high growth business is they quiz them on that. We had a client who came to us. They were going on to Dragon's Den, and they wanted us to do a valuation because they didn't want to appear like an idiot in front of the Dragon's Den panel when they got asked about their valuation. And again, it wasn't about the number. It was about understanding what those drivers in the valuation were. The rest of the things, I guess, are pretty explanatory. I think, unit economics, again, it's about understanding what they are. And in a high growth company, often those might not be mature, but you need to understand what the drivers are. In a traditional business, those are usually well established. You can look at the margins from the last 3, 4, 5 years and trend that. High growth company, not so easy. And then competition. This is one of the big things I think that has an influence on valuation. Is in an established business, you kind of know what the existing competitors are. They're easily identified. In a high growth company, you don't know. You can get competition from all sorts of different and unexpected angles, because if you're growing quickly, you may be encroaching on verticals or other industries that you hadn't even have thought were competition from the get-go. So one of the mistakes we see people make here, though, is they assume that they're first to market, they've got pricing power, and that's always going to be there. But as competition comes along in your models, you do need to factor often in a reduction in margin and, understand what that means for your value. So, yeah, those are a few points I just wanted to highlight. Yeah, Graham, maybe we can move on and then kind of wrap up.
Just actually great on the Dragon's Den point. Actually, Graham, did the founder you were advising, did they get the investment? Was the valuation?
So they haven't yet. They actually it's been recorded in a couple of weeks' time. So
cool.
Yeah, it'd be interesting to see.
Yeah, because no one gets the valuation right on Dragon's Den, do they? Whatever you exactly. Go in, they always argue it. There you go. Next section.
Yeah. So I think we've spoken around a lot of these things, but again, points of emphasis. So we talk about value drivers and value detractors, and often they're the opposite side of the same coin. But when you're thinking about a high growth company, it's not just about thinking what are the things that I can do to increase my value. You also need to think about what are the things that detract from value. So a lot of this is also about focus. You can do 1,000 different things, but what we've found to really make your company valuable is you need to understand what are the 2 or 3 key value drivers that you're going to focus on for your business. Focus is absolutely critical. And then what are two of the three of the big things that can actually detract from that? So, strong growth rate, number one. I mean, we're talking about high growth businesses. You need to be able to demonstrate that and how that can continue. Okay. It's easy to grow at 1,000% in your first year. Can you maintain that in your second year? So showing an understanding of what's needed to move from low base growth to higher base growth. And what does that taper look like? Cash conversion of profits. Again, we keep harping on this. This is absolutely critical. Even when you're looking at revenue multiples and that, what's implicit in that is that you're going to be able to convert that into profit at some point in time. So understanding your cash conversion of profit, absolutely key. Your IP and trade secrets. We talk about this, but you might want to broaden that again, as we said up front. It's around what are the moats that you're building around your business. Now, we see a lot of businesses that start. Simple stuff that you can do here is make sure that your brand name is protected from day one. Go and register the trademark of your business. Go and register the domain. I've seen too many horror stories where somebody's built a great business. They haven't registered the web domain, or they haven't purchased the trademark, and somebody else steals it from underneath them. That can happen. So those are really important things to think about. And then recurring revenue. I just want to emphasize this. We talk about quality of revenue and unit economics. There is this thing around how repeatable is that revenue. So subscription models are kind of the end thing. If we just think about Microsoft, for instance, and some of us are old enough to remember this, 15 years ago, you would go and buy Microsoft Office off the shelf and you would pay, 100 quid once off for your PowerPoint, Outlook, and what have you. Nowadays, Microsoft is a subscription product. You pay, £100 a year to have Microsoft 365 on your system. So they've successfully converted that from a once-off to a recurring revenue base. And I think this is a very, very key driver in businesses if you can do that. And then on the detractor side, it's kind of the inverse of that. Owner dependence, probably the single biggest one. I want to emphasize this one because a lot of startups get it wrong, and I think this only becomes important down the line. It's a really boring one, but your financial information, your bookkeeping, your record keeping, these are absolutely critical. Start from the beginning. Make sure you've got good records in place. I've seen too many deals fail at a DD or even a next funding raise fail when there's poor accounting records. And there have been some pretty high-profile cases where this has been the case. So, I think bookkeeping is a big one. And then high customer dependency. What a lot of businesses don't do is they don't shift. They grow quickly, but they don't shift from kind of having one or two kind of key influencer clients to kind of spreading to having multiple customers. So, those are the ones that I wanted to highlight. Graham, I don't know if you want to touch on anything else here before we kind of wrap up.
Great. No, the only thing I wanted to emphasize really was the importance of the strong growth rate. And you'll all know this when you come to do your or work on your valuations, and let's just say you are running a DCF, a discounted cash flow, you'll see that the growth rate assumption in there has a massive impact on the value of the business, which is why we always, when we're working with our clients and advising them, the faster you can grow within reason, and obviously in a sustainable way, the better your valuation is going to be. So the growth rate today is having a massive impact on your valuation tomorrow. And if you're raising money when you've had a flat year and you haven't grown, your valuation is not going to be as attractive as it is if you're coming from a strong growth position. So for me, I think that's one of the most important kind of assumptions in the model, if you like.
100%. And I think the point there is it's not growth at all costs, it's sustainable growth. And all these kind of levers actually talk to is the growth sustainable? That's actually the question you're asking. And anybody can grow quickly if you give away your product. It's a lot harder to grow sustainably where you can repeat that year after year after year.
That's it. Those are the best businesses, I guess.
100%. So in terms of wrapping up, and, we only have 45 minutes. So, it's really, you could probably spend a day on each of these topics. So today's almost a little bit of a teaser, but I think I want to focus on sort of the 4 key takeouts from today. Is your valuation is essentially a function of risk and reward. Again, it's coming back to first principles. So how certain are your future cash flows, and how much can you grow them by? So certainty of cash flows and how quickly and sustainably can you grow them? Number one. Number two is start with the end in mind. And I know this is hard because, you start with an idea, and, entrepreneurs are naturally curious and they're experimenting and all of those sort of things. But you kind of have to have an idea in your mind where you want to go. Are you building this as a lifestyle business? Are you building this for a potential exit? Are you building this for, a particular, strategic that you want to sell to? And if you have that end in mind, then you think about your unit economics, these kind of key growth levers that we speak about: growth and market potential, your owner dependence, understanding of customer, your systems and your processes. Those are kind of the key value drivers we want to think about with that end in mind. The third point is high growth companies have got some unique characteristics. They are slightly different to traditional SMBs. And that's why you need to place even more emphasis on understanding the drivers and understand the scenarios. What happens if I do this? What happens if I do that? And understanding the sensitivities around that in a high growth company. Because of higher growth factors and higher discount rates, small changes often make a multiplicative or exponential effect on the business and on the valuation. So that's really important. If you understand those differences between a high growth company, you understand the importance of scenario planning around that. And then the last thing is the drivers are more important than the valuation itself. I keep coming back to this, is the valuation is just a number. There's no precise right number, but understand for your business what the key drivers of value are and focus on those. If there's one takeout from here, understand 3 key value drivers for your business and focus on those. And the specifics of those might be different from business to business, but at a principal level, it's around growth, unit economics, and cash profits that represents, and repeatability and sustainability and scalability, which talks to the system. So, these things keep coming through and through over and over again. You probably heard enough of my voice. I don't know if there's any time for a few questions, Graham, but that's it for me.
Yeah, I love that last point, actually. Thanks, Graham. That was really awesome. Our last point is about drivers and how that's more important than the valuation itself. I think it's really important because if you really focus on your drivers, you can actually be in the position of building for value and creating the valuation that you want for your business, rather than the valuation being kind of put upon you, if that makes sense. So a really powerful point. We do have some time for some Q&A, actually. I know if people need to drop off in 2 minutes, that's absolutely fine, but we can hang on for another 5 minutes or so to get through these questions. But let me just share some of these questions with you, Graham, and we'll get into them quickly. So one question here from Arthur is, who should take the lead in initiating the valuation, the investor or the founder? And what are the benefits of the founder leading the valuation in terms of investor relations?
That's a fantastic question. So I'll be direct on this one. In my view, the founder needs to take the lead on this. An empowered founder is absolute gold. And the investor is going to do their own valuation in any case. And this comes back to the last point that we made, is if you're sitting with an investor hat on, you want to know, does this founder understand their business? Well, is it their first rodeo? If they're some naive guy with a great idea, okay. Or are they somebody who understands the idea, understands the market, or they're understanding what they're going to do? That's really what investors are looking at when they say, can I back this jockey? If you're a serial entrepreneur, you've had 3 or 4 exits, obviously you've got a track record and credibility that's slightly different. But for most people, they'll build and sell maybe 1, 2 businesses if they're lucky in their career. So for me, it's all about the founder taking ownership. I think it gives confidence to investors if the founder is able to engage in a sensible discussion around valuation, and often sometimes pushing back. I read something the other day, where it demonstrates belief in your idea if you've got a good understanding and handle on your valuation. And sometimes saying no to a funder, they might say, we'll give you 500 quid, 500,000 quid at, I don't know, 5 million valuation for 10% of the business. Sometimes if you push back and say, no, I want $1 million and this is why I want $1 million, that demonstrates confidence. So for me, the two go hand in hand. Founder needs to be empowered and they can have a balanced conversation with the investor. Remember, the investor often is a professional investor. They've done 100 of these. They're doing 100 of these a month or 100 of these a year. So, they're experts in this field. So empower yourself and, sit at the same table as the investor, not be a taker of what they tell you. Hopefully that answers that question.
Yeah, awesome. Thanks, Graham. Agreed. And yeah, it just gives you more powerful negotiating stance as well if you're empowered with this information. And you have
Graham, if I can maybe make one more point on that, it also allows you, not just to always take the first investor that comes along. Sometimes it's the wrong investor. And if that investor doesn't believe in your vision, you need to be able to walk away. And I think there's a lot of power in that. And sometimes also understanding your value and whatever. Sometimes you don't even need to take funding. When you go through the process, you might realize, actually, I don't need funding. I need to focus on something else. Or, so yeah, that for me is really, really, very important.
Awesome. Thanks, Arthur. Thanks for the question. One other question. This is going to get your brain going, Graham, at the end of the nice technical one for you. From Douglas. For DCF methodologies, when is it most appropriate to use MPV or IRR?
Okay, so I'm going to explain this in, Labrador language, hopefully. Okay. So, and Graham, correct me if I'm wrong. So NPV and IRR are actually just, they kind of two sides of the same coin. Okay. So an NPV is a number. It says your valuation is X. Okay. And in an NPV, you use a discount rate. Your discount rate is your required rate of return. So it's effectively your hurdle rate or the rate of return that an investor is going to expect. So if we're using a discount rate of 30%, it's saying that an investor is going to expect a 30% return on their money annually. Okay. And IRR is an internal rate of return. That is the actual rate of return that is delivered, that's implicit in that valuation. So if you take the valuation and you take the cash flows and you work backwards, you get to your internal rate of return. Okay. So if your internal rate of return and your expected rate of return are the same, you're going to have exactly the same NPV. I'm trying to explain it in simple terms. Hopefully that makes sense. But the IRR is the implicit or the implied rate of return in the valuation. Okay. Graham, you might want to modify that.
A hard one to explain in 10 seconds for sure. But yeah, for me, the IRR, which is the rate of return that the business is delivering, the model, is ideally in line with or in excess of the returns required by the investor or the person buying the company, because that means that actually you're getting that you're not losing value on the investment. You're actually gaining value on the investment in relation to other things you could do with that money. But very difficult one to answer in 10 seconds, to be honest.
I'm happy to take that offline. I mean, maybe I can. I know we're almost out of time, but one last thing is there's often something called a WACC, your weighted average cost of capital. So sometimes people ask, like, what's the difference between the weighted average cost of capital and the discount rate that you use? Again, that kind of is in the same realm of this question. I mean, I'm very happy to reach out to whoever's asked the question, and we can circulate that to attendees as well, and we can take that offline.
That'd be great. Let's do that, Graham. Yeah, that sounds good. More of a detailed response. I think that's pretty much it. All we have time for now. We've got some really good comments. Insightful masterclass, which is great. Awesome. Great. Thanks so much, guys. We are out of time, so apologies we can't take more questions there. But thank you so much for joining us. It's been a pleasure. And Graham, thank you for running us through quite a complicated topic in 45 minutes and giving us some really good takeaways. And I've really enjoyed it, and appreciate you being here. So thanks, and thanks to everyone for attending. And perhaps we'll do a more detailed one next time on DCF, how to prepare DCF or something, Graham, perhaps. But
listen, anytime, Graham, and yeah, just to you and to all the listeners and attendees, thank you for having me. And yeah, as we discussed before, if there's any other questions or follow up, please feel free to reach out either to either one of the Grahams. We work very closely together, so very happy to take anything offline if there's anything that comes up.
Yeah, if you need help with evaluation, please do get in touch, or anything else, a financial model, whatever it may be. We're here to help, and also happy to have an exploratory call, a discovery session to help you along the way as well. So please do get in touch, and looking forward to seeing you all again on a future webinar. Thanks so much. Take care.
Thank you very much, everyone.
Bye.
Ciao.